Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Hello and welcome to Wealth is in the Details with Peter Raskin of Raskin Planning Group. Good morning, Peter. How are you?
I'm great, Eric. How are you?
Oh, I'm doing fantastic. You and I were talking a little bit ago, and the sun was out this weekend. And
that felt really good.
It feels great, but I was only out there for like an hour, and my wife is just making fun of me because I burn quickly. I'm very white, so now I'm very pink. But it was very, very nice to be out there and feel that sun on our faces. And I know that you brought David Fay on the show today, and I'm really excited to hear what he has to say. And again, we were talking before the podcast. You said you guys have been working together for like 15 years.
Yeah, it's been a great relationship, and David has helped so many of our clients.
Fantastic. David, thank you so much for coming on the show today.
Well, it's a pleasure to be here. Thank you for having me.
Yeah, absolutely. Peter, why did you bring him on the show? What does David do for you and your clients?
Good question. David is a mortgage loan officer with Washington Trust Mortgage Company. He helps our clients and many, many other people get mortgages for their residences and for their investment properties and their second homes. And with interest rates, this is now the first weekend in May, where we're just past the first weekend in May, and interest rates are down probably to the lowest point they've almost ever been in. A lot of our clients are looking at either refinancing or if they are buying properties, which is a little tough to do right now due to the coronavirus and the lockdown that we're experiencing. But if they are able to do that, mortgages are really advantageous right now. So I thought it would be a good time to hear from an expert. And so that's why I brought David on.
Fantastic. Well, I'm here to learn because I could always use a little bit more knowledge on real estate. I've got a couple pieces of property, and you never know what to do. So
exactly,
I'm here to learn. Thank you.
So David, why don't you tell us a bit about yourself and Washington Trust Mortgage Company?
Sure. Washington Trust Mortgage Company, well, we're a subsidiary of the Washington Trust Company. So Washington Trust was founded in 1800, and it's the oldest community bank in the nation. The largest state chartered bank headquartered in Rhode Island. We offer a comprehensive range of financial services through our offices in Rhode Island, Connecticut, Massachusetts, and I've been in the lending business for over 30 years, helping all sorts of homeowners find financing solutions. And I specialize in portfolio lending, non-warrantable condos, conforming loans, as well as jumbos, super jumbos, and one of our specialties are doctor-physician loans. And we offer adjustable and fixed rates, and one last one, construction loans too.
Well, that's great. We'll go into some of the details and definitions of what some of those items are. But one of the reasons why I brought you on today is because you have always helped our clients relative to their mortgage needs, and you have exceeded expectations, our expectations, clients' expectations over that time, over this long period of time that we've known each other. And that's what businesses need to do. And so you're a trusted resource as far as I'm concerned. With that in mind, what I'm hoping that you can do today is help our listeners understand the mortgage marketplace and hopefully pave that path for a successful transaction.
Absolutely. That's what we're all about, Peter. And it's always nice working with your clients because you've gotten their financial house in order. So by the time they get to me, they're ready to go and they're all fantastic customers. So you make our world easy on this end. But, if someone's starting out, the best place to start really is to have a thorough discussion with the loan officer about the financing goals. Really, how long do they plan on being in the home? How long do they plan on having the mortgage? What's more important, either the length of the loan or the monthly payment? So armed with that information, we'll be able to tailor a solution to fit their individual needs. For example, like on a fixed rate, you can customize the terms of your loan by selecting different amortizations, whether it's at 30, 20, 25, 15, or even 10 years, while adjustable rates are amortized over 30 years. But you can select the initial term, whether it's fixed for the first 5, 7, 10, or 15 years.
And David, when you say amortization, what you're talking about is how long the loan is outstanding, how long you have to pay it back.
Exactly. That's right. And there's no prepayment penalty on these loans, so the customer could pay it off at any time they like. So if they don't plan on being in the home for 30 years, or maybe it's just they're going to be there for 10 years, maybe they do a 5 or 7 or 10-year arm and just borrow the money for that term. Generally, those interest rates are a little bit lower than a 30-year fixed.
Yeah, with interest rates as low as they are now, in some ways it seems to me to make sense to maybe pay a little bit higher and lock in your rate, even if you're only going to be in that property for 5 to 7 years.
Definitely. You want to buy yourself some insurance at that point, basically.
Yeah.
So if you lock it in for a little bit longer than you think you're going to be there, you have some protection as we know, life happens and some other things pop up. So it's good to have that protection fixed in for a few more years so you don't have that holding over your head.
Yeah.
Sometimes if people are looking for shorter term financing, another option might be a home equity line of credit or a HELOC. These options carry lower fees up front, but often higher interest rates. So it's a trade-off. It's a line of credit, so you can repeatedly borrow, take money out, and then pay it back without having to get a new loan. So these are great to have in place for emergencies.
Yeah, I often recommend that homeowners just establish a HELOC. It doesn't cost anything or very little, and why not just have access in the event of an emergency?
That's it. Yeah, the best time to get a HELOC is when you don't think you need one.
Yeah, exactly.
And then, other types of loans, if you're back into, an amortizing loan, often we're asked what the difference between a conforming and jumbo loans are. Essentially, it's the loan size. In most counties around the country, a conforming loan size is $510,400. So that's determined by the Federal Housing Finance Agency, and they review those numbers each year and set that number. So it's changing. It's continually gone up over the years. And then conforming loans, these conforming loans that are under $510,400 are guaranteed by Fannie Mae and Freddie Mac and basically protect the lender against certain losses, while jumbo loans are not. So that's why you'll see different pricing between a conforming loan amount and a jumbo loan. So those can vary. Those spreads vary from time to time. So when you go to finance, if you're close to that conforming loan number, you want to look at rates on either side of that to see what works best for your situation.
Hmm. Yeah, we always recommend conforming loans if it's possible. Not
Yeah,
always, especially in the
yeah,
marketplaces that we work in, the Boston area.
yeah. That's generally where the best rates are going to be. So,
Yeah.
we've been talking about financing single homes here, but we also have financing available for, whether it's investment properties, second homes, or multifamilies, 2 to 4 units. These properties can require larger down payments. And, if you're looking for financing for a unit greater than 4 units, then that's when you get into a commercial loan.
Yeah. When we're talking about investment properties, sometimes we talk to our clients about 1031 like kind exchanges where someone can defer capital gains on the sale of an investment property, and financing can also sometimes be part of that solution. Sometimes it's required to bring over and have an ongoing debt with a 1031 like exchange, and you guys can help with that as well, I assume.
Yes, we can do that. So there, with the 1031 exchange, there are some time restrictions in there. So you need to be able to react quickly if there's property comes up and purchase the new one within a certain time frame. And we're able to accommodate those.
Great.
A few of the other specialty loans we can customize as well are our construction loans. So if your client's looking to build a home from the ground up or even a renovation loan, if you're just looking to add a small addition. I mentioned earlier about doctor loans. So these doctor loans are a specialty that we have that allows for low to no down payment options without mortgage insurance. These loans really fill a need for those new physicians whose earnings just increased, but their savings haven't had a chance to catch up.
We see a lot of the doctors who they're just getting out of residency, and they get their first big position, and they don't have they still have a lot of debt out there. It's a very hard situation, and these kind of specialty loans really do fill that need.
Absolutely. We also have do loans to foreign nationals or non-U.S. residents. Those have been pretty popular lately. So whether the client's looking to purchase a second home or in some cases a condominium for their child while they're in college, but these loans can require, for the foreign nationals, require down payments of 40% or more. And then, another option for, say, for seniors might be a reverse mortgage. I'm sure you've heard about those in the news, but that's for homeowners who are 62 and up, and they can tap a portion of the equity in their home and turn it into cash without incurring a monthly payment outside of insurance and real estate taxes.
Yeah, I think the reverse mortgage is really an interesting option for a lot of seniors who are looking to for some additional cash. We find that they don't always fit our clients' objectives, but when they do, they're really an important consideration.
Yeah, it's been a great development, and to help the seniors stay in their homes.
Absolutely. David, you guys have a lot of different products available. One of the things that our clients are always asking is, what are the costs? And some of the obvious things are points and closing costs. Could you talk in detail about these costs, because there is a cost to taking out a loan?
Yeah, Peter, closing costs definitely add to the overall funds required to close. There are typical fees such as appraisal, attorney, title search, title insurance, recording fees, and potentially escrows for real estate taxes and homeowners insurance. There could also be points charged in conjunction with the rate you choose. For instance, the bank may offer a lower interest rate in exchange for a point or two paid at time of closing. So 1 point equals 1% of the loan amount. And if you plan on being in the home for a long time, it may make sense to pay points in exchange for lower rate over the life of the loan. So depending on how long you're going to be in the home, that point could pay for itself, and you could save the cost of the point plus a lot more money. If you make less than a 20% down payment, your lender may require mortgage insurance. Mortgage insurance protects the lender against loss if the borrower defaults. And mortgage insurance can be paid by the borrower monthly in a lump sum at closing, or by the lender in exchange for a higher interest rate. It's a good idea to look at each option.
Yeah, I think these expenses, the expenses of actually taking out a new mortgage or refinancing, really comes into play, especially trying to determine whether one should refinance or not. So we're seeing advertisements right now of very, very low interest rates, but because of the expenses of refinancing a home, there's often a payback period, and if that payback period is a long time, maybe it's not worth refinancing, even though there's a lower interest rate available. But if that payback period is fairly short, maybe it does make sense to do it.
Yeah, I think it. Every lender's trying to show their interest rates in the best light possible. So when you see something in the paper, you want to dive in a little bit deeper and see what costs are involved, because those aren't always advertised.
Yeah, that's for sure. But David, what drives the decision to amortize a mortgage over 10, 15, or 30 years?
Yeah, Peter, that's another great question. So a lot of people default to the 30-year fixed rate just because that's what they're used to hearing. That's what they think they should shop for. But For some people, it may be an aversion to debt and wanting to pay it off as soon as possible. So they may want a shorter term. And then other people may want to have a lower payment. And so the lower payment would be associated with a longer term payback. Um, Typically, the shorter the term, the lower the interest rate. Although in our current environment, with the interest rates fairly flat yield curve, there's not a big difference between the short and long term rates. So going back to your previous point, it might make sense to go a little bit longer term to get yourself some of that protection.
What I try often to talk to clients about is the kind of the options of that 15-year versus a 30-year mortgage. And even if interest rates are similar for the longer term mortgage, just be paying a lot more interest over the life of the mortgage. To me, it becomes almost like a real no risk savings plan to have that shorter amortization if you can afford the cash flow.
Right. Yeah. That's so if the 15 is the cash flow is a little too much for you, it's a good idea to maybe look at that 20-year fixed rate. Because a
Yeah.
20-year could have a lower interest rate than the 30, but slightly higher than the 15.
Yeah, that you can really in today's world you can almost design any mortgage that's appropriate for you.
Yeah, and that's why it's really important to have that conversation up front with your loan officer, just to narrow down what your goals are for the house, for the financing, how long you want to have it. It's real important to have a good, thorough conversation with your loan officer up front, so you're choosing the right term for your needs.
How much should customers put down, and how does that affect the rates?
So mortgages are priced based on risk. The less you put down, the riskier the loan is for the lender. So you'll see higher rates with lower down payments. A customer should put down as much as they're comfortable with, but 20% is a good benchmark. One of the mistakes I see when a client wants the best rate possible, so they decide to save for a larger down payment. In the meantime, interest rates have gone up. So even with the larger down payment, they may end up with a higher interest rate. Moral of the story is to not purchase a home based solely on rates. Buy it when you're ready.
Yeah, I think that's absolutely the case. You just can't time interest rates, and sometimes you just have to go for it. If you found the property that you really want and it's the right time, you just have to go for it.
Right. Yeah, I see a lot of people trying to finagle, try to figure out when that low point is, and in the end, it might only be a difference of $20 or $30 a month in their monthly payment. So
Yeah.
not a big difference.
David, how does credit score influence the rates? We hear so much about my credit score. I'm getting emails probably once a week about my credit score and how can I improve it and all that. So what does that really mean?
Yeah, as we talked about mortgages being priced based on risk, so credit scores directly reflect the risk in a loan. Does the borrower have a history of paying their debt obligations? What's the likelihood the lender will be paid back? A credit score above 740 will make you eligible for some of the best rates on a conventional loan, where a jumbo loan can have pricing improvements for scores up to 800. So a credit score could be considered your financial reputation.
What are the best ways to make sure that your credit score remains high? Are there strategies that one can take, and if your credit score is lacking for a variety of reasons, what can you do to get it back up there?
Yeah, so some of the basics are just what you think they'd be. Make your payments on time. Don't carry a lot of debt. For instance, on a credit card, if you can keep your balance below 50% of the overall credit line, that's going to be a help. If you can not open a lot of credit cards, that will be helpful also. And also on the converse side, if you've had a credit card for a long period of time, you don't want to close that out right before you go to get a mortgage, because a credit card that you've had for a long time with a good payment history, if all of a sudden you cancel that, then that comes off your credit history.
That's really helpful because we often have a lot of questions from our clients about credit scores and how they're just confused, and I think they, as you say, just pay your credit cards on time.
That's it. Pretty simple.
I do want to mention that interest rates for mortgages may be deductible, and that's advantageous for having a mortgage. And I thought I would just chime in to describe those deductible rules. So for mortgages taken out after December 15th, 2017, the first $750,000 of a mortgage is the interest is deductible. So that's really helpful. It used to be $1 million prior to 2017, but that got changed. So now the limits are a little bit different. HELOC loans were also deductible, and they still may be if they're used to if that debt is used to buy or build or substantially improve your home. So you have to really look at the nuance of the mortgage that you have to determine if the interest rate is deductible. And I will say this, for a lot of our clients, interest, no matter what their interest rate is, it may not really be deductible because of the tax laws. They may be filing under the standard deduction rules, which means that they don't get to itemize, and therefore the mortgage interest deduction may not apply to them.
Mm,
The interest deduction is helpful, but for a lot of people, it's really not going to be that applicable. So I just wanted to mention that.
good point.
When a customer comes to you, you have that initial conversation, David. What should they expect from a mortgage process? Describe this whole process. What do they need to do?
Right. The application process can be fairly paper intensive, and I find the more documentation we receive up front, the faster and cleaner our approvals are. So, the basic information required verification would be income and assets. For income, probably the last 2 years, your personal and business tax returns, W-2s, 1099s, K-1s, and a current pay stub or two. For the assets, we'll be looking for the 2 months most recent bank and investment statements. After we have the client complete the online application and submit the required documents for an approval, with the completed appraisal, excuse me, let me start that section over. After completing the online application and submitting the required documents, an approval with the completed appraisals routinely issued, say, within 30 days. A client who provides thorough documentation up front can expect to receive this commitment much sooner than that. So talk to your loan officer and let them know your time frame so they can expedite the process if you need financing a little bit quicker. Once we receive the application, we're required to issue disclosures within 3 days. So this is one of the most important disclosures that the customer will receive throughout the process. It's called the lending estimate. So this document we'll receive within 3 days. It estimates line by line the anticipated monthly payment and closing costs associated with the loan. So it's a great summary of the transaction, allows easy comparison between lenders' offers. So you can kind of see which lender is charging what and see what option is going to work best for you. So the lending estimate is received at the time of application. Closer to closing, you're going to receive a closing disclosure, and that's required to be sent to the borrowers 3 business days prior to the scheduled closing date. The closing disclosure has the final details of the mortgage program and costs. That's the one that everybody's really interested in. How much am I going to have to bring to closing?
Absolutely. David, should the customer hire their own attorney for the closing?
Yeah, Peter, that's best left up to the borrower to decide. The attorney's fees listed in the closing costs and that lending estimate are for the lender's attorney. Many times, the lender's attorney will also offer buyer representation for a separate fee. I would highly recommend getting buyer representation on a purchase. There's a lot of money on the line, and this is one of those times you don't want to do it yourself.
And what kind of fee is that typically? Is it a percent? Is it a flat fee?
A lot of the attorneys, I've seen some of them will include it in the overall fee. Some of them have a separate line item, maybe $650 for buyer representation. It can vary from attorney to attorney.
Yeah. But you just want to make sure you're protecting yourself, as you say. This is a big transaction.
Yeah, definitely.
I think the key to the process is just gathering all the information that's necessary. And that can be overwhelming, but it's required. I mean, there's just no way around it. The banks need to verify information. So they're just going to come back and at the borrower asking for verification of lots and lots of items. Are you able to accept those items electronically?
Yeah, that's probably the best way to get them is electronically. Send them over, on a secure link. Sometimes the lenders will have a site you can upload them directly into the loan application. Chances are most clients will have all their information electronically now, so it's a little bit easier actually to upload documentation. And these are all things that we need to verify. When the bank makes a loan, the regulators will want to know how we made the loan and how we determined the loan. And we need that backup documentation to back up our decision.
Sure, absolutely. Many of our clients and listeners may not have that much earned income. They may be retired or semi-retired, but they still may have significant assets, and it still may make sense for them to have a mortgage. And so, how does earned income affect this process? Can someone still borrow without actually having a lot of earned income?
Right. The number one way a lender uses to determine a borrower's ability to repay is by calculating a debt to income ratio. This ratio should be at least at 43% or less of their gross monthly income for the payment. So for earned income, it's pretty easy to calculate this ratio, but for those borrowers who have significant assets and little earned income, it becomes a little more challenging. For these borrowers, we can add up their eligible assets, such as savings, retirement funds, stocks, bonds, mutual funds that they have unrestricted access to. We can then take that sum and calculate a return on investment or to come up with a hypothetical monthly income. We can then, this asset depletion program can be the perfect solution for those borrowers with significant assets but don't show much income on their tax returns.
So basically, it sounds like in order to borrow, someone has to have assets that can be used to pay back that loan if they don't have a source of current income.
That's right. We
Yeah.
again, we have to show how we came to a decision how this borrower is going to repay that loan.
So we talked a little bit, David, earlier about refinancing, and could you just talk a bit about just when someone should consider refinancing for that lower interest rate? What goes into that calculation?
Yeah. Anytime interest rates are low, like they are now, it's a good time to explore refinancing. If you're in an adjustable rate mortgage, you may want to look at refinancing into a longer term adjustable, or even into a fixed rate. So be sure to look at the different terms, as shorter terms will carry those lower interest rates.
When we talk about a payback period, could you describe that?
Yeah, payback or break even is the time it'll take you to realize enough savings to cover the cost of a refinance. Even if current rates are lower than what you're paying, you'll want to calculate the break even period to see if you'll actually save money.
So yeah, I mean, we're often seeing the no points, no closing, having the closing costs wrapped into the mortgage. What is the best way to go?
Right. So we were talking before about the closing costs. Well, refinancing a mortgage costs money. So there are three ways to pay for it. So you can either pay for the closing costs out of your pocket. This will most likely save you the most money over the long term. Number two, you could roll the closing costs into the new mortgage. This will save you out of pocket money, but you end up paying interest on that extra money you add to the loan. And three, ask your lender if they offer a no points, no closing costs loan. Sounds too good to be true? Well, almost. In some instances, a lender can price your loan at a higher rate, which would provide a rebate large enough to cover the closing costs. While your break even period may be immediate, the higher rate wouldn't offer as much savings as you paying the closing costs out of pocket with the lower rate. So you want to take those all into account.
Yeah, I think so much depends upon how long you see yourself in that property with that mortgage. If it's a longer term, then paying up front may actually be a much better decision.
Absolutely. Talk it through with your loan officer.
Yeah, exactly. David, you've been a great service provider. You prepare our clients for the process. They feel comfortable with you. They trust you. We do as well. So, what makes you in Washington Trust different? And then, how does someone reach out to you?
Right. Thanks, Peter. It's been a joy working with you and your clients. Everybody is so prepared. Your clients are top notch. It's been great. Washington Trust is a Rhode Island-based bank headquartered in Westerly, Rhode Island. We're actually the nation's oldest community bank, established in 1800. We offer a range of conventional mortgages along with our own portfolio loans where we make all the decisions locally. This allows us to make fast, common sense decisions that many other lenders can't. Best way to get a hold of me, I hate missing calls, so my mobile number is best. Call or text me at 617-429-2059. Otherwise, send me an email at dfay@washtrustmortgage.com. Thanks for having me, Peter. I truly appreciate it.
Oh, it's been our pleasure, and I will say that if a listener does want to get in touch with me, or I can refer you on to David, please reach out. My direct contact is 617-728-7433, and you can certainly check us out on at our website at raskinplanning.com, and our contact information is there as well. So, David, it's really been a great pleasure. We've worked with you for all this time, and you're just a great resource. I know I call you all the time with questions about mortgages. Oftentimes, you can help our clients. Sometimes most recently, I called you about a client in New Jersey, and you guys aren't licensed to work there, but the information that you gave me was really helpful. So, thank you for being a great service provider as well as a great resource for our firm. So thank you very much, David.
Thanks, Peter.
Peter and David, this was fantastic. Thank you so much for taking the time to do this podcast. David, what a fantastic guest you've been. Obviously, if Peter's been working with you for 15 years, that's something to say. I've known Peter for quite a while. Just an amazing guy to be podcasting with, and I have a good time with him. Peter, it's so interesting. You brought up that the best way that clients can get documents to David. And I know on the last podcast, we actually spoke about the technology that you guys use at Raskin Planning Group for your clients. And if I'm not mistaken, it's called the Vault, right?
Yeah, exactly.
And that's something that they can organize all their documents. And David, you said that the clients can actually submit all that stuff to you digitally, correct?
That's right. Yeah.
Man, that's beautiful because you've got the technology on both sides that it's pretty easy to work with Peter's clients, I would assume, because they've got these documents in the vault ready to go. You say, okay, these are what we need. I'm assuming, Peter, they would be reaching out to you saying, hey, this is what I need. Can you help me get this out? Or you've got staff members that can help them. Or I know that you also train your clients to be able to use that vault. How does that work? Do you just then help them shuttle those documents over digitally to David?
Yeah, I mean they would have to do it themselves because it's a different portal to the bank's information. But yes, we would help them do that. Oftentimes, the bank will request current statements on their investment portfolios, and we have all that. So we would forward it to the client and work with them and help them upload the information. So we try to make it as easy as possible.
Yeah, and David, I'm assuming it's got to be a whole lot easier that way than dealing with someone like me who's like, okay, now it's going to take me a week and a half to find all these documents in a drawer someplace in my house, and then I just bring you a big mess of paperwork and say, okay, what do you need out of this?
Right.
How do you help those clients, David, figure out which documents that they need? Is that something that comes directly from you, or is it a group of people that are going to be communicating with them, or do they have one point of contact?
Right. We'll set them right up front and give them a list of the documents that we'll need. Oftentimes, I'll be directly in touch with their accountant or with Peter, and Peter can send the documents, with their authorization directly to me, or the client could upload them securely to the application that they completed online.
Awesome.
That's probably the best way to go. That way they're secure.
Yeah, super easy, secure. I think that's fantastic. David, if you haven't heard the last podcast that Peter put out, it was all about technology and the different things that they use, and also just kind of some thoughts and ideas for the common person, and what you can do to make yourself safer. So you should go back and listen to it. And audience, you should as well. But one last time, David, I want to thank you for being here. And Peter, I want to thank you for bringing him on.
Absolutely. Thank you.
Thanks for having me. It's a pleasure.
You bet. And I want to thank you, of course, the listening audience, for tuning in to the Wealth is in the Details podcast with Peter Raskin. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Peter comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Raskin Planning Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corporation, a broker, dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln affiliates and other fine companies. Raskin Planning Group is not an affiliate of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.